Look at earnings. Everybody's talking about earnings up 6%. They're up 6% because energy was basically zero and it went to $130. Earnings are up 6%. If you strip out energy, one sector, I'm not stripping out and making it look nice and then stripping out food. I'm stripping out energy. It's big because it's the one sector that, unfortunately, as that rises, is worse for the economy. It's worse for consumers. If you strip that out, earnings fell 4% year over year. I'm not talking about that at all. I'm talking about this earnings growth, and these companies are meeting earnings. And we stripped out energy when it was shit for the S&P 500. Now, but we're not stripping it out now when it helps the S&P 500. Isn't that amazing? But ex-energy, earnings are down 4% year over year. That's significant. That's significant. But most importantly, I need you guys to pay attention here. I'm hoping I don't lose you because there's not a lot of people that talk about this. The massive contraction in M2, which, by the way, was the biggest contributor to the Great Depression. So if you're looking at M1, it's the total amount of cash, current account balances. M2 is everything in M1, but with savings account, money market funds, and other deposits included. So it's basically the total money in circulation in our economy. Now, M2 is also known as the velocity of money. It's a measurement of the rate at which money is exchanged in an economy. So high money velocity is usually associated with a healthy economy, expanding economy. So if you're on our YouTube page, I want you to take a look at this chart, which is significant. Because you're seeing, and let me blow this up, the absolute crash in M2. As you can see, the last time it was at this level, which is 1.1, I'll cover that in a second, was back in the 1930s during the Great Depression. Pretty crazy when you think about it, right? Why is nobody looking at this and paying attention? So the velocity of money was above 1.5 every year since the 1950s, meaning the turnover of a dollar into the economy is $1.50 as it filters through the economy, right? So the higher this number is over 1, the better. It means there's more transactions being made with goods and services, thus translates into a healthy and growing economy, okay? This is the simple part of it. Okay, I don't want to get too complicated. For example, in the mid-1990s, the velocity of money was over 2. That's very, very good, right? We had the tech boom, everything going crazy. From 2010 to 2019, it averaged around 1.6, almost 1.7, so solid number. Today, the velocity of money is at 1.1. Again, the only time this figure was at this level was the Great Depression. It's a clear sign. Clear like a car going 100 miles an hour and it's about to hit you and you see it coming, as clear as day, that we're heading for a recession, probably a decent one. And maybe a lot of that is factored in with stocks down, companies about to lay off. Some of that is factored in. But now you have Powell, who wants to continue to raise rates and shrink its balance sheet in the face of M2 collapsing. Now, if he's serious, which he may not be, Fed speak is powerful. Just by talking, the Fed can reduce inflation, reduce demand, can control the world just by talking, just saying what you're going to do. And that's fine. That's okay. I get it. I'm hoping that's what it is. But if he's serious, which a lot of people believe right now, and it continues to aggressively raise rates with housing already crashed, the NASDAQ down 20%. Again, 70% of household wealth is right there. Stocks and housing. Look out. Because I have news for you. If that crash comes, and this happens, and he follows through, and it's going to be 100% caused by the Fed, who missed inflation, missed everything over the past 3 years. You don't want to pay attention to Jackson Hole. If he did the exact opposite, if he did the exact opposite of what he said the past 3 years, we'd be on much better footing, a much better economy. GDP would be healthy. Unemployment would be okay. Wouldn't be as bad. If you were raising rates right away in 2021, instead of continue to pour trillions into this market, just like what our government is doing right now, continuing to spend money like crazy. So if this crash comes, which would be 100% caused by the Fed, you're not going to be able to hide. Because every single asset class is going to get crushed. I talk about cryptos, bonds. I mean, the amount of debt on the balance sheet of companies and our government is at all-time highs, and we're aggressively raising rates still. And we're not seeing defaults as much. We're not seeing bankruptcies. That's what you're going to see if you keep going. You're going to see it, and you're going to see it a lot. Forget about owning collectibles. Gold, forget. I don't even know what the hell drives gold anymore. I have no idea. I have no idea what drives gold. I talked to Marin Caduce yesterday when we were talking about it. He's like, he was, I won't say depressed, but he's like, I just can't believe the assets that I own and how great they are not doing anything. Like, why isn't gold going higher? Like, it just doesn't make sense. I don't even know, but forget about it. Especially gold stocks. Maybe gold prices might hang in there. Maybe they go a little bit higher, but gold stocks, forget it. They're all freaking diluted through the ass, right? A lot of these guys don't make any money at all, right? They looking at, mid-tiers and the large ones, yeah, they're printing money, but nobody cares about those either. The Newmonts, Kinross, nobody cares about those. Those guys are printing money and printing gold, raising their dividends. Their earnings are strong. Nobody cares, right? They're producing at $900 with gold at 16, 17, wherever. Nobody cares. But the rest of the gold market, no stocks, forget about it. Holy cow. The only safe haven will be the dollar. Which everyone says is going to crash because our government's a bunch of idiots and they spend money. You're right, they are idiots and they spend a ton of money. But last month, it was at a 14-year high. Yesterday, it hit a 20-year high yesterday, right? What does that mean? People are nervous. Everybody goes to the dollar when they're nervous. They truly believe that Powell is serious. I'm hoping that he's not. He's going to keep raising rates based on lagging indicators. And by the way, the Fed has to stop looking at the CPI as its main indicator to judge inflation. And this made sense for a long time, so you should revise this model. I mean, I covered it numerous times over the past 30 years to where this index rarely showed inflation, which allowed for easy monetary policy, even though we all felt it. We all felt inflation from 2010 to 2019. So you should shout from the top of the roof. We got inflation. But yet inflation, if you look at the CPI, was under 2%. Why? Because they revised it to where there's almost impossible to show that inflation is going to surge. That's why they strip out food and energy. But now this method's coming back to bite you in the ass, since 32% of the CPI accounts for shelter, where most of this is rental income. Food accounts for 15%, energy accounts for 8%, which, again, the Fed, government, whatever you want to call it, did a great job of spitting out the core of this. Well, food and energy, we're fine, right? They spin out for political purposes, obviously. Just like suddenly we change a textbook definition of a recession overnight. So a recession is no longer defined as 2 straight quarters of negative GDP. Look up the definition. Go into the dictionary, Google it. And it's going to say recession. 2 straight quarters of negative GDP. That's what it is. But we just changed it. Why? Because we have very important midterm elections coming. And there's no way the current administration could admit that we're in a recession or it's going to lose the House and the Senate, which is pretty much a foregone conclusion. They're probably going to lose it anyway. Even if you bribe college kids by forgiving $10,000 of their debt 3 months ahead of elections. Which, by the way, if you really wanted to help these kids, why not just have the institutions of the schools lower tuition rates? We all know the answer to that. We all get it. We're not idiots. It's politics. It's the way it is. Again, $500 billion to do this. $480 billion was used to bail out the world and the banks to save our financial system from collapse, ultimate collapse. And in a second, with a signature, with a few people making a big deal about it, not really, $500 billion. Man, I feel really bad for all the people who paid off their debt and the college students that paid off their debt, because it sucks for you, doesn't it? For doing the right thing. Do the wrong thing. With this administration, you're fine. But to do this, taxpayers are paying for this just ahead of the election. No coincidence there. Is crazy. You have to pay attention to politics.